Hey, Ian, thank you. Welcome, everybody. This is our second series of the Accounting Design Project. I just remind you what it's all about. We feel a need to really attend to research that deals with accounting itself, how you do the accounting, what's good accounting, what's bad accounting. We feel that's part of our sort of almost our basic mission, our sacred mission. I believe we had a very successful set of papers in the fall. Actually, this pandemic thing has sort of been partly inspired this. We all have to get together online and do online seminars from all over the world. So we welcome Young, and I have Young has done a wonderful job on doing this. For all those around the world, wherever you are, welcome, and I trust we'll have a very stimulating and thought-provoking spring. Over to you.
All right. Thanks everyone for coming. As Stephen just said, we had a wonderful series workshops in the fall and also have great speaker schedules in the next few months. Today we have Steve Monahan from the University of Utah to talk about this interesting paper titled Evaluating for Price Informativeness and its Determinants. So before we get started, I would like to lay out a few ground rules. Everyone except for the presenter should stay on mute to reduce background noise. If you feel comfortable, please share your video so we can have a more interactive workshop. If you have a question, you can raise your hand, use the raise hand function in Zoom, or just type question in the chat box. I will interrupt Steve and invite you to ask your question. And feel free to state your name and the school before you ask a question. If you would like to just leave a comment without necessarily interrupting the workshop, you can type your question, type your comments, and please, if you do so, please note that you don't want me to give you some time to make the comments. With that said, Steve, you will have the first 5 and last minutes uninterrupted. I will give you a 5 minutes warning towards the end of the presentation. With that, the floor is yours, Steve.
Okay, thank you, Nina. And also thank you, Ayang and Stephen, for giving me this opportunity. This is a paper that my co-authors and I started actually quite a while ago, and then because of disruptions and scattering to all corners of the earth, we've kind of just coming back to it now. We're trying to figure out exactly what to do with it, and so we greatly look forward to your feedback and input. The title is Evaluating Price Informativeness and its Determinants, and so I think before I get into exactly what we do, I want to start a little bit by talking about, why we care about security prices. This is one of those things that a lot of people understand well, but it took me a long time to really fully grasp these issues. So maybe this is me just exploring my own ignorance, but regardless. So first of all, what securities allow investors to do is to smooth their consumption over time. So, I can take the income I earn today, I can put it into some sort of security or basket of securities, and that'll allow me to save for the future, or it facilitates risk sharing. I can buy an index fund, and therefore I don't have all my eggs in one basket. But I pay a price for that. And in particular, the price I pay for that index fund is the price of the securities in it. And if those security prices are close to the fundamentals, then I'm kind of getting a fair deal. If the security prices are far from the fundamentals, I'm not. Firms also clearly are going to care about security prices because the notion of the primary market, so if you make an offering, obviously the more that you get for the shares you issue, the more stronger incentives you have to actually issue those shares. And in light of that fact, that can lead to allocations that are better within the economy. Good entrepreneurs are allocated more capital than bad entrepreneurs or less good entrepreneurs. And that provides incentives for people to be entrepreneurial. And in addition, then there's a secondary market. Now, just to be clear, we won't be looking at primary market transactions in this paper. We're going to focus on the secondary market. But that's important too, because people can learn from prices and they can adjust their real decisions accordingly. So, and there's papers, that some of you I'm sure have read that talk about ways that agents can learn from prices and decide whether, for example, to do a merger or an acquisition, or whether, for example, to determine how much to pay an executive through stock option compensation, which is a way essentially of learning from prices. And that gets the second thing that they can do is that they can use prices in contracts or when regulating. Okay. And so, sort of the short of this is that better, that is more informative prices mean better risk sharing, better consumption smoothing, better real decisions, and better incentive alignment, right? Like the more accurate the prices are, the better that the better securities will do at facilitating these activities. Okay. The second thing that I want to mention is how is this relevant to the accounting design project? Well, I think it's kind of goes back to a quote that I find myself coming back to pretty often, is that, the FASB, and I don't think we should always say, well, the FASB says this is why it's important, using, appealing to authority sometimes isn't the smartest thing to do. But I think in this case, saying that, the FASB, I think, is onto something when they say, look, financial reporting should provide information to help present and potential investors, assess the amount, timing of prospective cash receipts from dividends or the proceeds from sale of securities, right? So I'm paraphrasing from this entire thing you see in front of you. And the point of this is that, if one of the key purposes, arguably, of having a financial accounting system is to facilitate price informativeness. And so I think that's kind of the things we had in mind when we decided to work on this paper is that, price informativeness is important, and information is going to play a role in how informative prices are, and accounting systems are information systems. Okay. So what is our contribution? So although price informativeness is important, or at least we think it is, how to measure it and what determine it remain open questions. And there are some people that have got measures of it. And I'll talk a bit, if I have time, about our arguments about why we think our measure, or at least improves upon some of those, or maybe adds a different way of looking at things than some of those do. But right now there is no one measure that people have accepted. We're going to propose a new one, a new price informativeness measure. Our measure reflects the accuracy of investors' expectations about a firm's future earnings. And this gets us to a pretty, at least in our minds, straightforward interpretation. The more accurate those expectations are, the more informative the price is. Or, as you'll see, we actually kind of measure inaccuracy. And so the more inaccurate those expectations are, the less informative that price is. And what's a little bit nice about our measure is it can be used at both the firm level and the economy level. And this comes up with this firm level versus economy level point comes up with regards to another set of authors out there by Philippon and Savav, who have written a paper, and it's quite a nice paper, where they look at price informativeness at price level like we do, and we're going to make some arguments that we sort of extend on, build on, or maybe improve upon what they do. Okay,
Steve,
so this is our main
question.
Absolutely.
I have a question. Stephen,
Sure.
Please ask your question.
So, Steve, in your introduction, you talk about investors caring about prices, not returns. And I was just wondering a couple of clarifying questions. So first, do we care about absolute prices or relative prices? And secondly, do people make decisions based on the absolute price or the change in price? Because really we sort of pay attention to information when prices change. Right?
So I think that we care about absolute prices in certain circumstances, right? And so, for example, when we think about our investors, they care about absolute prices because that's what they're going to pay to buy a portfolio or buy a security. And similarly, I can think about secondary market prices where, if I go to work for you, for example, if you were nice enough to hire me and you gave me equity compensation, then I think in that case, we would care about absolute prices because that is going to be reflecting, perhaps at least with some correlation, my performance. And in light of that fact, if we think it'll be reflecting my performance well, in the sense that my performance links to expected future cash flows, and if the price also links to expected future cash flows, then we might be more willing to enter into that contract, both of us, because we know it sort of gives us what it wants. I know I'll be rewarded fairly, and you will neither over or underpay. Is this answering the question you're asking? I think this is Sudipta. But,
So suppose it's an option contract. What my payoff basis is based on the return from today, right? Because the exercise price is today's price. So the price isn't really what matters. In my view, it would be the change in price that matters. That's why I'm asking again. Is it the absolute price or the change in price that really determines my incentives?
Well, so, I mean, fair enough. I mean, the change in price over a pretty long horizon, though, right? It could be 5 years. The vesting period could be, it could be shorter. And so at that level, I can't argue with you that at some level, the change in price is going to be important. But I think you can think of other places where we use prices that the informativeness of returns is the change in price. And so it also depends on how informative the price itself is. And so I think at some level, the primitive, not to speak too high level, because I don't want to use words that overuse words, but the thing that really drives returns is ultimately prices. And so I think what people are ultimately interested in is prices.
I'll come back to this later, but let's keep going.
Okay, that's fine.
Yeah. The next question, David, have another question.
Yeah. So my question is kind of starting out looking at this a priori. How much would you expect price informativeness to vary? Because when I looked at your graphs, I found those quite intriguing. But then I step back and I say, well, fundamentally, what's causing changes in that informativeness? Is it changes in gap? Is it changes in analyst behavior? Is it what would drive it such that one would expect it to vary that much? Or maybe you didn't see or think that your graphs varied that much. So I'm just curious, how, a priori, what did you expect to see in terms of graphs of that over time?
I'll be honest with you, I can't remember what my priors were. I can talk a little bit about, and we'll get into this later, is that I think we lay out some of the things that we argue, determine price informativeness, which are things like, the degree of uncertainty, I think is probably the most fundamental one, right? Like ultimately, if there is no uncertainty, then price is going to be perfectly revealing. On the other hand, as uncertainty increases, then there are going to be things that no one knows, right? And by that I mean both firms who are producing information and investors who are searching for information, and that's going to cause not necessarily bias in prices, but that can lead to a lack of precision in the expectations that are driving the prices, in the sense that those expectations might be biased, but they still can be very inaccurate because they can be sometimes too high and sometimes too low. And so I would say probably the largest driver in my mind would be uncertainty. But then I think there are some other things that matter too. I think that information production decisions matter. I think also that the amount of information acquisition that's being done is going to matter. And that gets to what you mentioned about analysts. And then finally, I think you can talk a little bit about investor behavior, but this is something that we really don't want to get too much into this paper, because this is not an anomalies paper, about the fact that, investors the way that investors acquire and interpret the information that they acquire might not be fully rational, but this isn't really a paper about that fourth thing. And I would argue the primary driver would be uncertainty. And the last thing I'd like to say is I didn't catch your name, and I can only see a couple of people on the screen. So if you can tell me who you are now and also going forward, that would really help.
Dave Zebart at University of Kentucky.
Thanks, Dave. No, thank you, David. I just can't see you. For some reason, you're not coming up on my screen.
Yeah.
The next question, Ayang.
Yeah, hi Steve. I'm Ayong. I have a question follow up on what Dave just asked. So when I look at the paper, I think it's kind of exactly how you define price informatives is actually the accuracy, or you can think about it as a mapping between the investor's expectation today and the future realization, right? And then you define that if there's a higher correspondence, possibly correspondence, that means that this expectation process or pricing process is more informative or have a higher quality. And my question is that what if the underlying earnings distribution has a different uncertainty or distribution? Some firms' fundamental environments are just more volatile, and other firms, it's just harder for investors to predict future earnings. And speaking about your economy level analysis, during downturns, usually uncertainty is higher compared to boom years, and it's just harder for investors to predict. So how do we interpret your result as price informativeness or just another proxy for uncertainty?
So I don't think it's just another proxy for uncertainty. And a couple of reasons for that is that we try very hard to actually control for the level of uncertainty. And we can try to do that, more if you can think of suggestions for that by, essentially creating a variable that reflects both the difference, forecast errors, as well as sort of a terminal value correction, and then also a stochastic discount, or the discount rate, if you will. And then we try to clean those things out. And when we're cleaning those things out, we control for things like, volatility, market to book ratio, earnings to price ratio, another number of other things. And when we're doing that, I would argue that a lot of that actually is going to pick up some of that uncertainty that you're talking about. And so I'm not sure how much the variation in our measure, the residual variation in what we measure, is attributable to uncertainty, especially at the economy level. And the other thing I would say is that, the things that we're focusing on also are the regression coefficients, right? And so we come up with the measure, and then we regress that measure on various phenomena that we think are interesting, some of which might be interesting not just to accountants, and then some of them are interesting to accountants per se. And we would argue that as long as those measures aren't correlated with the error term in those regressions, and we try very hard to, make that not be the case by orthogonalizing our variable against a number of other variables, then we're picking up simply, the correlation between that construct and the variable we're interested in.
Yeah, I think related to that is, I feel my question is more on a conceptual level. I feel like this price informativeness versus the earnings volatility is kind of like two sides of a one coin. That's because essentially you are capturing the correlation or correspondence between the expectation of earnings today and the realized earnings in the future, and the earnings underlying distribution of volatility would definitely be part of that.
Well, I mean,
correlation.
I'm not going to disagree with you one bit that the ultimate driver of, the ultimate thing that you have to keep in mind is that prices are going to be perfectly revealing in a world where there is no uncertainty. And so, with that sort of in mind, as uncertainty increases, all else equal, prices will become less informative. But there are things that agents can do to also increase the degree of informativeness by, for example, some agents can produce information. Some agents can require other agents to produce information. We call those the FASB or the IASB, as well as securities regulators. And then some agents can go out and seek out information. And so, the ultimate thing that drives uninformativeness is uncertainty, but we don't live in a world where people just live with uncertainty. They attempt to seek out information where they can reduce, or they can reduce the amount of residual uncertainty.
Thank you.
Okay, so I'm going to skip through what our results are, and because I think it's useful to get to the measure. I'll come back to the results, obviously, when I get to the tables. But this is basically, what we're going to do is we're going to combine a result that comes from Olson 95, and then Feltham and Olson, sorry, not Feltham and Olson, Christensen and Feltham 2009. And basically, what those combining results in both those papers leads to this expression for price. So price is expected aggregate cum dividend earnings, and I'll say exactly what those are in a moment. And then basically those are capitalized by a risk-free rate, plus a terminal value correction, plus a covariance term. So what aggregate cum dividend earnings are is they are the sum of reported earnings plus the sum of what you can think about as foregone earnings. So these would be the earnings that the firm would have reported had it not paid dividends and had it instead held the dividends, held the cash inside the firm as excess cash and basically invested it in risk-free bonds. Okay, and so this allows the earnings construct we use to preserve notions of dividend policy irrelevance. And so then the terminal value correction, really all this is, and this just comes from the math. And so kind of the easiest way to think about this is that if the covariance term is equal to 0, that is, if we live in a world where people are risk neutral, then the terminal value correction is just equal to the change in the difference between price and book. But once you have risk aversion, then what you get is that this terminal value correction is actually equal to the difference between, and this is being a little bit careless with language, it's not exactly the value that's expected to be created after time t plus cap t. It's the amount of residual income that will be expected to be realized after t cap t, minus the amount of residual income you would have expected to have been realized, assuming no growth. Okay, so that's what the terminal value correction is. And then finally, what we've got is this covariance term. And this is just this is the covariance between the stochastic discount factor, or Q. And, basically what that is that that's the future value of an insurance policy that I would buy today that would give me $1 of consumption in state S at time t plus K. That's that future value, that covariant with the amount of dividends I would receive in state S. Okay. And so if state S is a really bad state of the world, then the value the future value of that insurance policy is going to be more valuable. It's going to cost me more. And then basically what you're going to see is this covariance term is going to tend to be negative because dividends tend to be negative in bad states of the world. And so this covariance term is negative. And then we discount this back using the risk-free rate. And so this gives us an expression for price, and then the risk-free rate is described in the paper or described here. What's nice about the risk-free rate is it's known. Like, because of the results in Christensen and Feltham, what you can do is you can actually express this where the risk-free rate you're using to capitalize those earnings is a known risk-free rate at time t. Okay, it's not an uncertain risk-free rate like it is in Olson and Feltham, or Feltham and Olson.
Steve,
and so
Ollie have a question.
Yep. Sure.
Hey Steve, one quick question. So just something conceptual here. So when I look at those formulas, I believe that a lot of these formulas are built on the assumption that the earnings we currently have are basically representative of how earnings in the future will behave. So, and then I was looking at your measure also, and you have certain spikes in periods where price correction occurred. So then one question I had was, given that also in these periods, you typically see depressed earnings and things like that, could that also then imply that you could spin the measure the other way around, so that in this case, earnings are just not that representative of value because you might have these short-term hits. So in that case, the measure would rather speak to earnings informativeness rather than price informativeness. I was just wondering what your thoughts on that were. Yeah,
I mean, here are my thoughts, and you might not agree with them, but my thoughts are, I'm not sure I think that there is, clearly different accounting systems are going to produce different earnings numbers, some of which may capture value more quickly than others and what I mean by more quickly is the length of time over which you aggregate. But nothing in here relies on any particular type of accounting. This is sort of the blessing and the curse of these expressions is that they'll work for any clean surplus system, right? So as long as book value today equals book value yesterday plus earnings minus dividends, then all of this will actually go through. And so and then having said that, so I agree with you that to a certain extent, you have to be thinking about whether earnings actually over the window that we measure them maps well into equity prices. Does it capture a lot of the value that's created over that period? And that's why we pick a fairly long period, about 7 years or about 10, and then we do robustness checks with 10 years. So we look over pretty long horizons. And, there's some papers out there that show that over those horizons, quite a bit of value does tend to get captured. Particularly, I'm thinking of Pittman and Sugianis. And then also what we do is we try and clean up for problems that might arise because we don't have a long enough horizon. And to explain what I mean by that, it's useful to then, take this equation I show here and then move into, okay, what is our measure? So our measure, and this is not actually the end game of our measure, this is the first stage of sort of doing our measure, is to create this variable diff. And so diff is going to be very similar to P, price, except that diff also has the actual realized aggregate cum dividend earnings from date T, where I'm standing right now, to date capital T, where I'm standing later, subtracted out from it, where they've also been, grossed up by the risk-free rate appropriately, or capitalized by the risk-free rate. And so, what we're interested in is that thing in green that you see in diff. That's what we want to study. Now, clearly, when we just look at diff, we don't have that. And so there's three issues that we have to grapple with. And I think this is kind of the, where the rubber hits the road in terms of, if you think we grapple with these well, then, you're going to find our results to be appealing. If you think we don't grapple with this well, then you're not going to find our results to be so, or at least our interpretation of our results to be so appealing. So first of all, the simple one is that, these are all raw values, they're in dollars. That's clearly not something we want to do. And so we're going to deflate by price. We also deflate by book, and we get pretty similar answers when we deflate by book. And so, that's the first thing. The second thing is we have to choose a horizon. Now, we're going to initially choose a 7-year aggregation horizon. I'll explain why we do that in a moment, but we also look at robustness over 10 years. And then the real big one is we've got to get rid of these two things, terminal value correction and covariance, right? Because clearly, and this gets back to, I think, some of the things that Young brought up, and also something that Ali brought up, and they're really bringing up this COVE term and this TVC curve, because you might worry that to the extent, and especially at the economy level, that uncertainty translates into risk, which translates into this covariance term. Then we could just be picking up variation in that covariance term over the time. And this is also something that David brought up earlier. And then also what Ali might be, I think what Ali's really bringing up to sort of put it concretely is that this TVC term, it's picking up everything that doesn't get picked up by the aggregate cum dividend earnings up to 7 years out. And so we need to get rid of those things. And, so basically here's what we do. So first of all, our choice of T, we're going to set it to 7 years. Okay. And we do this because we look at, some literature on time to build. There's a paper by Cueva who argues that the average time to build is about 2 years. And so we say, well, okay, we picked a communist 5-year plan and then said, okay, if you go out 5 years, then you'll know that you'll pick up all the projects. If you go out 7 years, you'll know you'll picked up the results of all the projects on average that started within the first 5 years, and some of the projects that started within years 6 and 7. And but we can't go out too far because we need a sample, relatively long period of time. We need a sample, right? And so if we pick 28, years, 28 quarters, we're not going to have any sample left over, or not much. And so we need a period of time. Now we also conduct robustness tests where we do set T equal to 40. Our economy level tests, some of the results become insignificant. The signs don't change. We would argue the overall tenor doesn't change, is the same. And we would also point out that when we do that, we lose an awful lot of degrees of freedom. We go out 10 years. And so we're estimating a large number of coefficients with a fairly small number of data. So we actually think the 7-year results are more descriptive. The firm level results, the results are robust. Okay, so this is how we pick the length of time to aggregate earnings over, right? And if we could go out to infinity, then the issues that Ali brought up would be a problem. But we can't do that, so we go out 7 years. Okay, how to get rid of TVC and COVE, right? And so there's going to be this terminal value correction that's left over, and there's also going to be this covariance term. And so basically what we're going to do is we're not going to use the variable diff. Rather, what we're going to do is we're going to take the component from diff that has left over after, which we call error. And how we do this is we estimate a first stage regression of diff on variables that we argue are a function of the terminal value correction and the covariance term. or changes in them. And so these are things like the log, natural log of market value, the book to price ratio, the earnings to price ratio, and contemporaneous annual returns. So annual returns for year T. And these are things that we would argue would be, related to both this covariance term as well as the terminal value correction. We're also going to put in variables that reflects firms' exposures to economy level factors. And so this is beta, the factor loading on, small minus big. So the factor loading on book to market, HML, or the factor loading on size, and then momentum. And so what we're trying to do is, both kind of put in the factors and the factor loadings themselves, with the idea that if we've done this, then the component that's left over will be uncorrelated with either TVC or COVE. It will be orthogonal to them. We also include, and this gets to, one of the responses I gave to Young, we include a measure of volatility, and we include, and in some of our regressions, we include several measures of volatility, and then getting to something that Ollie, hinted at or brought up, is that also the other thing you might worry about is that you might say, well, okay, this is great that you say when you've got clean surplus accounting, this holds, but maybe you don't have clean surplus accounting. Fair enough, we might not. And so what we do is we have this variable DIRT, which picks up actually the aggregate, the ex post violation of the clean surplus relation that might cause those aggregate earnings to not actually be equal to the change in book value plus dividends, minus dividends. Sorry. So,
Steve, question.
So that's, yes.
Steven has a question.
Yeah. I'm a bit. I'm trying to work this through, Steve. Sorry you can't see my beautiful face, but for some reason the camera's not working on my Zoom, so you got me blank. But I do have a voice. You got me a bit. There's a covariance term here, which you've put up as a covariance of dividends with the kernel. But substitution should go there through earnings, so it's the covariance of earnings. So that's part of the. That is part of the. If price is just, roughly speaking, the present value of come dividend earnings, it's the risk for those earnings that are there. So I don't understand why you're putting these other things in which actually capture those covariance risks, or these control variables that capture that covariance risk, given that covariance risk is actually the risk to your numerator, your future come dividend earnings. You seem to be trying to take that out.
So I would say two comments to this. The first one is it's a technical one, but it's one worth making, is that if you actually go and read Christensen and Feltham, and I'm sure you haven't, so I'm sure you're just forgetting this, but actually it's no longer earnings, because if you want to express ACE in terms of known risk-free rates, then what you find is that you actually end up recovering the covariance term between dividends and the stochastic discount factor. And you can rewrite that in something that looks a little bit like earnings, but it's not earnings like you would think of it in terms of the Feltham and Olson 99 paper or residual income. And that's kind of a technical answer. So I
don't understand that, because you got M&M here, dividends don't matter. If a firm pays no dividends, until liquidation, the covariance is zero. And you don't have to take consumption with the dividends. The idea is you generate earnings which buy the consumption. It's a covariance of the earnings. Or actually, you might say the covariance of the future book values with the earnings, and the dividends are paid out of the book value. So in my mind, that's the covariance is in terms of the risk to the numerator. Okay, that's which is the
I understand what you're saying, Stephen. Yeah, I understand what you're saying, Stephen. And I mean, I'll go back to saying that you can get something that looks like earnings by playing around with this covariance term, but it's not going to be residual income, and it's not going to be earnings per se. It's a little bit different. It's actually the extent to which earnings growth is above a certain level. That's the variable that goes in there that you can replace in there instead of dividends. I can't remember what it exactly looks like. And then another point I'll make is that, look, even in M&M, you've still got firms ultimately paying dividends, right? Because the long run ratio of price to the discount rate converges to zero, right? You've got the transversality condition, which means that ultimately there has to be some payout.
No,
Yeah.
M&M says,
But I get your point.
M&M says that there has to be payout and liquidation, which is a boundary condition. But up to that point, the dividends say nothing about the value or nothing about the
They
risk.
can be whatever you want them to be.
Yeah,
I understand. And the other thing I would, but you do need that transversality condition. But these are, like I said, these are kind of technical points. I agree with you that ultimately risk is driven by the risk of the fundamentals. I'm not going to argue with you about that because that would be a dumb argument to make. What I'm going to say though is what we're interested in is this notion of forecast accuracy. We don't want to be picking up variation in risk. And the reason why we don't want to be doing that is that then we run into this argument that maybe we're just rebottling old wine in new bottles, in the extent that we look at things like firms, how fine of information they provide in terms of less aggregate accounting information, or whether they provide guidance. And some people might say, well, you're looking at variation in risk. Or similarly, and I would argue this is, I actually am less worried about that at our firm level results, because I think we do a lot of things to clean that risk component out. And then at the aggregate level, I think a lot of people would say, well, you're really just picking up time varying expected returns. And that's why you're getting the results you're getting. And we're very sensitive to that. And so what we're trying to do is say, no, we have gone through and cleaned out that covariant term. It's not time varying expected returns. All it is the forecast error embedded in the expectations. Okay.
But if earnings,
does that make sense?
No. If it in fact,
okay, well, explain to me why then, because I'm curious.
If the fact that the earnings create the dividends, okay, and the book value the dividends are paid out of, that's a Queen-Surplus relation. So that's what at risk. So the covariance term is that's at risk. If you put other variables in to take out that risk, okay, your expression says it's based on the expected earnings discounted for the risk, okay. If you take out that covariance, that risk, then you seem to be throwing out the baby with the bathwater. The risk is to your future dividends are current book values plus earnings minus any interim dividends, future book values, and those future book values, dividends eventually will be paid out of book value. That's what it's risk, and the earnings that create that book value are what's at risk. At risk, you don't want to take out that
but we're not
covariance.
But we're not trying to measure risk, Stephen. We're trying to measure errors in investors' expectations, which can happen even in a riskless world, in a world where investors are risk neutral. It can happen in a certain world, but it can happen in a world where investors are risk neutral, right? And so we're trying to focus on this thing in green. What is the difference between what they expected to happen and what actually happened?
Yes, and that's going to depend on the covariance.
I'm not sure that's true, because I mean, what I would say to that is that, clearly there, uncertainty that is correlated with state variables that investors cannot diversify away from is going to be manifest in the covariance term.
Correct.
But uncertainty that is uncorrelated, idiosyncratic errors, et cetera, is not.
Correct. Yeah. Okay.
And I would argue that it's that second type of uncertainty we're interested in. Now, if you're not, it's not. We're not trying. This is not a paper about discount rates. This is not, and this is a paper that's purely about, how good are the expectations embedded in price. That's what this paper is about.
Well, why are you looking at the unsystematic, unpriced risks if you're looking at prices? I don't quite understand it. I'm lost. I'm sorry.
Because no, it's okay. I think this gets back to, the very thing I started with is that, again, prices are important because they do things like, they facilitate, for example, risk sharing consumption smoothing, right? But so let's imagine we live in a world where investors make really big forecast errors. And so this thing in the green box is really big. Then, what's going to happen is that says that sometimes investors grossly overpay for consumption smoothing and risk sharing, and sometimes they grossly underpay. Now, on average, they could pay the right price. We're not talking about bias, but they could still be over or underpaying because they have, they make big forecast errors, right? And similarly, if you and I enter into an agreement where you hire me to work for you and you say, I'll pay you in shares, and so I give you restricted stock instead of, stock options or stock options, then I think you and I are going to be a lot more comfortable with that arrangement if we know that those shares actually, the expectations that cause those share prices to move are linked to the fundamentals, because in some senses we feel like we're getting, if I make the fundamentals better, you're going to pay me more, but you'll be happy you did that. And so we're not interested in this covariance term. We want to get rid of it. And I think you can still come up with very good arguments for why what we have left over is interesting, because it gets to, again, these things that prices do, that security prices do, that are, things we want to have done. Like, we want to allocate the right amount of capital to people who are entrepreneurs who are issuing shares. Now, we're going to look at the primary market in this paper, but that's something that, we would like to do. And in my mind, that has to do with, indeed, you're right, the pricing of risk, but also just simply how good are the expectations that are embedded in the price is. Okay.
I'm sorry to take up your time. You go on. I have to think this through. I haven't quite got it, but it's probably me. I have to think it through. The question, I guess, is this all consistent with no arbitrage asset pricing theory?
So that's a very good question, because this equation comes down to no arbitrage. Like, if you have no arbitrage, then this equation holds, right? This equation definitely comes out of no arbitrage. And what's beautiful about that is that it gives me a linear combination, right? It gives me a linear form. And so what I can do, I can estimate regressions where I can get rid of parts of the things in that linear, that sum, which is a linear function, by just good old OLS regression. And that's what we find appealing about this equation, okay? But yeah, this is a no arbitrage relation that comes out of Christensen and Feltham.
Next comment from Sudipta.
Okay.
So I think that to sort of really get at price informativeness, you have to sort of think about what is the information set that investors have, and how does that compare to the ex post outcome on which you're using your, which you're using for your measure of informativeness. So, if you don't know that there's a new regulation coming, or if you don't know that there's a pandemic coming, then your price could have been very informative up to the point when the pandemic hits, right? So the question is, in what sense does it make to measure informativeness when there's a gap between the information set on which prices are based and the outcomes on which you're measuring price informativeness?
So I would have two responses to this. The first one is, we talk about pandemics and things like that, then I think what we are talking about is uncertainty. And what we're going to try to do is two things. We're going to try to control for uncertainty. We're not going to do it perfectly, right? Because, the coefficient, the variables that we put in these regressions, things like volatility, et cetera, are not going to perfectly predict pandemics, right? And so, the comment I would make to that, though, is as long as the variables that we're going to regress, this error term on, the variables of interest, are not correlated with, the probability of, the likelihood of a pandemic, then yeah, we'll have some additional variance in the error term of those regressions that will be unexplained, but it won't be biasing our coefficients. That would be my first comment. My second comment would be is that I actually think that what we're after to a certain extent also is, look, actually the information set is of interest here, right? Like, when we think about typical market inefficiency papers, they say, given an information set, is the price unbiased, or are the expectations embedded in the price unbiased? But I think what's interesting about this price informativeness literature is that, now you're actually putting on the information set on the table too, and saying, look, the information's be decided by the firms in terms of how they disclose, the regulators in terms of what they make people disclose, and also the information acquisition choices that agents make. And so I don't think you want to say hold the information set constant. I think actually the information set is something you want to be interested in instead of controlling for.
Yeah, but it's still, there's a difference between, like you say, the volatile periods or the pandemic periods and sort of regular booms, of what Oliver was asking about, an unexpected recession, or Ayung was asking. So I think that gap between the information set at the time the price is set and the period when the earnings is actually realized will affect however you measure this. I mean, now you're measuring it over long periods and averages and all of that, but I still think that that's going to make a difference both in the cross-section and the time series it has to, right?
So absolutely, I mean, I'm not arguing it's not going to make a difference in terms of what diff is going to look like.
Mm-hmm.
I am arguing that to the extent that air cleans up some of this, air will be immune to this, or at least we'll ameliorate that problem. And then my other point is going to go back to is that, and also you have to explain to me why the variables I put on the right-hand side that are measured at time t would be forecasting things like pandemics. And so if, you want to argue that I've got a correlated omitted variables problem, and the variables I'm looking at is actually correlated with the likelihood of, for example, a pandemic, which I don't think they would be, or other, economic downturns, fine, but you have to explain why the other variables I've also put in the regression doesn't remove that correlation, why that variable picks it up better. Does that make sense?
Not convinced, but keep going.
That's fine. I've never convinced anyone ever. So, and so then, at the firm level, in addition to what we do, is we also put in a number of other variables that we simply can only measure on the annual basis. And so we can't put those in the aggregate level. And then what we're going to do after that is so now we've created this variable air, and now we're going to estimate a set of second stage regressions where we're going to include, in the economy level tests, things like the aggregate log of aggregate market value, the aggregate EP ratio, the aggregate BP ratio. And then we're also going to conclude, 7 additional macro variables. These are taken from, I can't remember the paper right now, Chinroll and Ross. And so what we do is we look at the variables mentioned in Chinroll and Ross, and we basically choose those ones that are correlated with our measures of informativeness, and we include those on the right-hand side in our second stage regressions. And these are variables that are absolutely trying to get at the issues that Ali and Sudipto are bringing up, is that these are things that are argued to predict, or these are sort of state variables in Chinroll and Ross that are argued to predict aggregate economic outcomes. And so if you think that the variables that we look at after controlling for these have bias coefficients, you have to argue that those variables are better at predicting these, downturns, et cetera, in particular risk than these variables. Because what we're trying to do is pick up basically state variables that pick up non-diversifiable risks by including these in the regression, okay? And also that TVC term, okay? The firm level, we do all this, and then we also include, some other, basically the same thing. And so,
Steven, we have another question.
Yes. Sure.
Peng Guo, please ask your question. We cannot hear you. Peng Guo, do you want to ask your question?
I don't know why. What's the problem with my mic? Sorry.
We can hear you now.
Oh, really? Okay, that's very okay. Thank you, Stephen. I think there are 2 issues. One is what you said is a no arbitrage condition. It seems to me this DIFF in your slide is your definition, right? It's not a no arbitrage condition. Is that right? It's your no arbitrage condition because
this expression here.
This one, yeah, this one is from no arbitrage condition, but this DIFF is not. It's your definition, right?
Well, it comes from like, so if price equals expected aggregate cum dividend earnings, capitalize expected aggregate cum dividend earnings, then we can simply subtract out realized aggregate cum dividend earning.
Yes.
Capitalized realized aggregate cum.
Yes, I understand.
And the difference is going to be a forecast error.
Yes.
Okay.
And then I think your next two slides, basically you just try to find some proxy to measure this covariance risk. For example, this beta and the book to market and the high managed level, this sort of thing. But because we don't know how many risk factors are there, so there are something we're left in your this. Just go down probably one slide or two slides.
No, I think you're talking about actually what we do here. And so you're absolutely right that we're trying to get rid of this covariance term and this terminal value correction term.
Yes, exactly.
By estimating these second
Just
stage
go back to
regressions.
this one slide. Yeah.
This slide.
This difference. You talk about this error term difference. Yeah, this term.
Right.
So you say if something, some risk factors is not in your proxy, right? Because this covariance risk can maybe, include many other risk factors are not included in your, book to market or carbon beta. And then that will be captured by this difference, by your, this, But so go back one.
Yes, you're correct. So you're correct. And so,
here, yes,
you're absolutely right.
Might be captured by this green, this blocks. And then in the second stage, you use this, this will include some macroeconomic risk factors. And then your right-hand side also use some risk factors. Is that right?
I didn't quite hear you.
Oh, sorry. Here, you choose a few proxies for the covariance risk. But certainly, the more are not included in this, there's a few proxies, but should be included in the covariance risk. But in your first stage regression, that will captured by your this difference error term, right? But then in the second.
So I understand omitted correlated variables, right? And so what you're saying is that the variables that we put in the first stage and the variables that we put in the second stage may not fully capture the COVE term and the TVC term.
That's right.
That's what you're saying, right?
Yeah.
I agree. They might not, but what we've done is we've gone through the literature and we've looked for the variables that show up in the literature as either being, measures of, book to price, earnings to price, returns, natural log of market value, factor loadings. We've also, in another set of tests that I haven't tabulated yet, we've looked at additional ones to these, and our results don't go away. And so I understand what you're saying. And then, when we do the economy level results, we can we look at a large number of variables that have been mentioned in the macro literature, and we look at those too. And so if you think that there is a risk variable that we haven't included and you can name it, then I'm happy to hear about it and include it. But we've tried very hard to include all of those. Okay.
Steve, you have 7 minutes left. Probably we can have one last question. Yang, do you want to ask your last question? Okay. Yeah.
I don't have any questions.
Okay.
I put it in the chat box. Yeah.
So what I want to do is I want to just very quickly say, so what we do at the economy level is we're going to measure, bias, which is just the mean of these errors. And that mean does not have to be 0 in every year, because how we take this error variable and measure it is in the first stage, we estimate panel regressions using the entire panel. And so although for the entire panel, obviously the mean of error has to be 0 because of the way regressions work, for any 1 year, error can have a, have a non-zero mean. We also measure the absolute value of this, because that's what really, you would be interested in. Is the bias is not interesting. The sign of the bias is less interesting than the unsigned bias. We look at the standard error, and this is our notion of precision. So what's the average precision for stocks in the economy at a point in time? And then we look at the sum of the two. The root mean squared error is putting the bias and the standard and the precision and the imprecision measure together. And so this is just, our raw unadjusted variables. And what we do is, what we see is that, first of all, we find that, during, for example, the 1970s, when there was stagflation, you see that clearly these things, the absolute bias, the bias is very negative, the absolute bias is very positive, and what you've got is, pretty high volatility. And then there's a period of time where these things sort of settle out and they just kind of, vary along. And what's nice about this is the bias just kind of varies along zero, as does the absolute bias. And then what you see is when you come out into the the end of our sample period in the global financial crisis, then you see that again, prices seem to be arguably too low. Our expectations seem to be biased downwards. Investors are a bit too pessimistic, and volatility is high. And so what we're then going to do, and I'm going to have to skip a few things, I just want to make one point, is that a couple of people have brought up that maybe we're just picking up variation in either risk or variation in this terminal value correction. At the aggregate level, again, we put a lot of variables on the right-hand side. And then what we're interested in is sentiment, and so basically when investors show high sentiment, that is arguably they speculate too much, or when they show extreme sentiment, either they expect, they're very either far too, speculative or far not speculative enough, just extreme sentiment. What does that do to the informativeness of prices? And one last point I would make is that the correlation between sentiment and absolute sentiment is darn near zero. And I know this doesn't exactly mean that there can't be any correlated, that if they're both loading in particular ways, then it can't be that there aren't correlated omitted variables that relate to risk of the terminal value correction. But it begins to stretch the imagination to think of what those variables would be that would be correlated with both of the components of these variables that are orthogonal to one another, because these variables are pretty much orthogonal to one another. And so, and then we have a number of variables that we're going to put on the right-hand side in our second stage time series regressions. And then this is kind of our, our headline result with the economy level results, is that we find that, first of all, when sentiment is high, expectations are biased upwards, and when sentiment is low, expectations are biased downwards. Or when sentiment is negative, so basically sentiment seems to be picking up optimism and pessimism. And what I think we find that's a little bit more interesting is with the absolute value of sentiment, and I would focus on the root mean squared error here, we find that when, basically there is extreme sentiment, either high or low, then aggregate prices seem to be less informative. The expectations just seem to have high volatility, not necessarily bias, but just high imprecision, okay? And so on average, they'll be a long ways away from the realized value, not necessarily in a predictable direction. Our firm level panel regressions, what we're gonna do is we're gonna take this variable abs error, which is just the absolute value of that error variable that we talked about earlier. So this is already something that's been orthogonalized, and we take the absolute value of it. And then we are going to put in these control variables, and we're going to calculate our standard errors the way everybody does. And then we're going to estimate, I'm going to have to flip through this, I apologize. We're going to estimate some firm level regressions where we also then again control for those same set of control variables again, because we can do that because we've got the absolute value in the first, is what we're bringing into that second stage regression. So these are the second stage regressions. And what we find here is that, first of all, and this gets back to some comments that people made earlier, and I don't think this is a particularly shocking or novel result, but I think it's in terms of construct validity, I think it's a nice result. Uncertainty measured by the volatility or the predicted volatility of ROE definitely is positively associated with uninformativeness. So the more uncertainty there is, the less informative prices are, which I don't think is particularly surprising. We also find that stocks that are covered or firms that are covered by analysts have more informative prices. And I think this is beginning to become an interesting result, because what this is saying is that analysts seem to actually create or uncover information that would not have been uncovered by investors on their own. And this gets to the view by some people that argue that analysts really don't do this very well. Well, they seem to. And then the thing that I think we look at next is just some things about firms' disclosure choices. And the thing we find that matters the most is this variable DQ. And so this is the disclosure quality proxy from Shevlin. I can't remember the names of the authors, and I apologize to the other two. It's my fault. But basically the point of this is a measure of how disaggregate or how aggregate the data are. In this case, how disaggregate the accounting data are. And what this is saying is that firms that provide finer or more information at the line items in their balance sheet and income statement, then their investors make more precise forecasts, okay? But what we find, I think, is also interesting is what we don't find. And so, for example, readability doesn't seem to matter much, and providing guidance doesn't seem to matter much either. And I think that what these things might reflect is that the guidance might lead to a reduction in short-term information asymmetry and a mitigation of short-term volatility. But we wait 6 months after the fiscal year end to measure our informativeness measure when we do these regressions. By the time that time has passed, these things have ironed out. So these sort of said that these issues might be in second order in a certain sense. And then finally,
you may want to just wrap up. Yeah.
Okay. So what I'll do is I'll wrap. So we provide a new measure of price informativeness, and we find these results. I would argue that again, this is something that the accounting system's supposed to do, right? It's supposed to provide information that investors can use to make better forecasts, and we care about that for the reasons that I mentioned earlier. And so with that in mind, at least in our minds, there's a lot more you can do with this, or we can do with this, in terms of how do accounting standards affect the informativeness of prices, other measures of firm level accounting quality, securities regulations, investor participation, et cetera, okay? And so with that in mind, I appreciate the comments a great deal. They were definitely be taken to heart. Thank you very much. Goodbye.
Thank you very much, Steve, for a very interesting presentation that promotes thinking. It's gone midday on the East Coast. It's gone midday in the East Coast. We have a new president, so maybe things are looking up. Although with the as accountants, we always wait for the realization principle to be sure of that. The other thing is, what's looking up is I get my first COVID jab in 2 hours. Okay, so this is really something to celebrate. The bad news about that is you have to be old to get it. Okay, so anyway, thanks everyone for attending, and we'll see you next time.